Treasury Department of the United States of America has just begun a new Treasury buyback program. This is something that they have done in the past to a greater extent, and it is something that they have been practicing for the last couple of months. Now, if you know anything about what the United States Treasury does, you might find it odd that they are conducting buybacks of their debt, considering they're typically the ones selling their debt. They're the ones who do the borrowing. So I'm going to explain, number one, exactly what is going on here. Number two, I will show you why they are doing what they are doing. And then finally, I'm going to explain the impact that this could have on both the markets and as a result, your portfolio. And if you don't know who I am, my name is Joe Brown. And in 2019, I quit my job as a stockbroker so that I could teach people how the economy really works so that you can make more money investing. And this is a prime example of why I do what I do, because if you don't understand what's going on here, and the implications it has for the markets, you could position your portfolio completely backwards and suffer losses as a result. So number one, what is a Treasury buyback? If you want to put it very, very simply, it's paying off your debt early. So you as an individual, let's say you have a car loan that matures or you'll pay it off in 4 years from now, you could pay it all off today, pay that debt off early. And essentially what you're doing is the same thing as what the Treasury does when they conduct a Treasury buyback. They have debt that they're going to have to pay back in full, let's say in 2 years or 5 years or 10 years or 30 years. And instead of waiting that full time in order to pay that debt back, they decide to just pay it all back now. And this is not the first time they've done this. In preparation to begin these buybacks, they have over the last couple of months been performing very, very small scale buybacks just to test out the system. But more importantly, in 2000 through 2002, the US Treasury engaged in a massive buyback program. Now, that buyback made sense because in the years 1998 through 2001, the United States government actually ran a budget surplus. That meant that they were taking more money in taxes than they were spending. And so it made sense from a financial, fiscally responsibility standpoint. They took some of that money and they said, we're going to pay off some of the national debt with this. But as you can see right here, we are nowhere near a surplus, and we haven't been anywhere near it really since the last time it happened back in 2001. So what in the world is the government thinking by paying off some of its debt early right now, participating in these buybacks? Because they're not taxing more than they are spending, which means the only way that they are paying off some of their debt early, doing those buybacks, is by borrowing other money. Yes, you heard me right. These Treasury buybacks is the government borrowing some money over here and using that not only to pay off the debt that they owe that has to get paid back right now, paying off extra debt, borrowing extra, pay off extra debt that's not even due right now. Which brings us to the second topic. Why in the world would the US government be doing these buybacks? If they're not running a surplus, why would they borrow extra money in order to pay off old debt early? And it gets even stranger when you take a look at interest rates right now. If you take a look at the US government's 10-year Treasury yield, it is currently at around 4.5%. That is the highest it has been since October of 2007, which newsflash was more than 10 years ago. So any of the 10-year debt that currently exists was borrowed at some point between 2014 and today, which means that vast majority of it, any 10-year treasuries that were issued outside of these little spikes, currently has a lower interest rate than what the government could get by issuing new 10-year debt right now. We get the same picture when we look at the 30-year yield. We have to go all the way back to 2011 before the yield was this high. And even then, it was only sporadically higher until we got all the way back to 2007. And we see the exact same thing with the 2-year yield. In this case, it's even more extreme. For the vast majority of the last 10 years, the 2-year yield has been very, very low, often approaching zero. And it gets even stranger because if we take a look here at the 6-month yield, and now we're getting into T-bill Treasury, which is debt that matures in less than 1 year, we see that that currently has the highest interest rate of all government debt. T-bills right now range from 5 to 5.5% for new bills that mature anywhere between 1 month and 1 year from now. And so if they were borrowing new 10-year debt in order to pay off old 10-year debt, that would be bad enough by itself, because they'd be borrowing new 10-year debt at around 4.5% to pay off old 10-year debt that might be as little as 1% or 2%. But in fact, that is not what's going on. The US Treasury is issuing extra T-bills in order to retire some of its older debt. That means they're borrowing in excess of 5%, close to 5.5%, in order to pay off older, longer-term debt that might be as low as 3 or 2%. You can see the Treasury's current schedule that they have announced with the dates that they will be participating in these buybacks, and the security type and the maturity range, as well as the maximum purchase amounts. So why would they be doing something that seems so preposterous on the surface? The answer is, quite simply, nobody wants this debt. There are some major liquidity issues that are showing up in the financial markets right now with long-term US government bonds. For about a year now, every single time the government tries to borrow with longer-term debt, 10-year auctions, 20-year auctions, 30-year auctions, we are seeing signs of stress and a lack of liquidity. This lack of liquidity is what led to some of the bank collapses, because they quite simply just couldn't unload all of the treasuries that they needed to, mainly because they were at a loss, but also because there's just simply not enough buyers for some of these large pools of treasuries that exist out there right now. On the other hand, the US government has absolutely no problem borrowing when they issue T-bills instead. There's a huge appetite to lend to the government for a year or less. There's very little appetite to lend to the government for longer than that. So right now, the US government has just decided it's going to take advantage of this. It's going to free up the system, increase some of the liquidity by taking off those less liquid treasuries out of the financial system by buying them back. And the way that they're funding those buybacks is by borrowing short-term debt instead. In other words, issuing T-bills. And the fact that the Federal Reserve's balance sheet is still headed down, which means that it's still participating in quantitative tightening, means that the Federal Reserve right now is not stepping in to be that buyer of those long-term treasuries. The financial system can't offload any of that debt, those assets to the Fed in exchange for cash, because the Fed's not buying right now. The Fed is selling. And so the Treasury has just decided, well, we will step in and do that buying ourselves. Yes, we will have to completely offset every dollar of old debt that we retire. We'll have to offset that with a new dollar of new debt, but they are freeing up, they are increasing the liquidity, they're making financial conditions a little bit easier for financial institutions, at least in the meantime. So what impact will this have on the markets, if at all? Well, the first thing to note is that these buybacks are actually relatively small. It shouldn't have a massive impact on the markets. This is just increasing the liquidity. It's bringing in an extra buyer for those longer term securities, and it's allowing some additional supply of those T-bills, which there's sufficient demand for right now, to enter into the market. Over the long term, this doesn't help the financial situation for the government. It actually hurts it, because they're taking old debt that wasn't going to mature for a while and had a lower interest rate, and they're replacing it with debt that will mature within the next year or so and has a higher interest rate. And so if rates stay where they are, this will actually make conditions much tougher financially for the US government in the long term. But for right now, it does free up some cash in the system. Remember though, it's not any net new liquidity. It's not like when the Fed injects money. It's not like when the Fed participates in QE. This is not a net injection of liquidity. Over here on one side, you have the government saying, okay, here are some dollars, give us back the asset. And then over here, you have the government saying, here's an asset, give us some dollars. And so from an accounting perspective, there's not any change to the balance sheet of the government, to the balance sheet of the private sector. This is simply a swap. The same number of dollars and the same number of assets, the dollar value of those assets, exists in the economy. No change. However, it does increase liquidity conditions still, because there are more cash and cash-like instruments available to financial institutions, and there's more liquidity. You are more easily able to sell those short-term ones. There's more demand for them, and it papers over the financial stress and the cracks that were beginning to appear in the Treasury auctions from the government. And if none of that makes sense, the only thing that you have to know is that what the government is doing right now is basically taking a credit card that it has a balance on and it's using that to make extra payments on its mortgage, hoping that doing that will somehow allow them to afford those minimum payments better later on. Now, if you did this, you'd obviously be setting yourself up for financial disaster, but with the government doing this, is it going to have any impact on your portfolio? Well, during the short term, interest rates, at least at the short end of the curve, are going to stay around the same. There's still about $470 billion in the reverse repo facility, which means that the US government can borrow as much as they want at the short end of the curve with T-bills until this thing hits zero without short-term rates going up. But what it does mean, and this might be a little bit counterintuitive, this should be a tailwind for markets. We've seen a big rally recently in the stock market, in gold, Bitcoin, silver, and most of these are simply just being driven by liquidity. And with the money supply headed higher over the last couple of months, that makes sense. And what the government is doing right now with these Treasury buybacks is more than likely to continue this. Additional liquidity drives asset prices higher. Now, there's a case to be made that what we are witnessing is a blow-off top, which means markets rally while economic conditions underneath deteriorate, and eventually then afterwards you get a crash. The case that can be made for that would be things like jobs numbers being revised down. Every time they come out, the jobs numbers look great. A couple months later, they're revised down. Most new jobs right now are government jobs, which are a net drain on wealth and society, not a net add. Credit conditions are deteriorating with household debt increasing, delinquencies and defaults on debt like credit card debt and auto loans increasing at record paces. Inflation is still ravaging household budgets, making just the cost of living harder and harder. Even as people make more money, their real wages are not keeping pace with the cost of living increasing. But remember, markets are not the economy. Markets can stay irrational longer than you can stay solvent. And it's better to be profitable than it is to be right. And it's reasons like this why members of Heresy Financial University who follow my portfolio are never actually positioned net short on the market. Despite my bearish opinions on the economy, that doesn't come through in investing. We invest for how things are, not for how we think things should be or how we think things ought to be. When the markets are bullish, stay bullish. Keep your positions uncorrelated. Hedge to the downside when the risks to the downside rise, and take a small percentage of your portfolio and play those asymmetric trades. And if you'd like access to me helping you out with all of that, sign up for Heresy Financial University. Link is below. As always, thanks so much for watching. Have a great day.